Hello traders, welcome back to the Forex Geek, where we dive deep into the tools that can help you make smarter trading decisions. In today's video, we are going to be looking and talking about the ABC pattern strategy, a powerful yet straightforward approach that can help you identify potential reversals or trade continuations in the market. Whether you are trading Forex, stocks or the commodity market, this pattern can give you an edge you will need to enter trades at optimal points. By the end of this video, you should know exactly how to spot and trade the ABC pattern like a pro, while also managing your risks effectively. So stick around with me to the end of the video to ensure you don't miss out on any key detail that can improve your trading results. So understanding the ABC pattern, let's dive into what exactly the ABC pattern is and why it is such a valuable tool in your trading arsenal. The ABC pattern represents three distinct price movements in the market that forms a clear geometric pattern. Point A, which marks the beginning of a powerful pattern, usually at a significant high or low. So if this is your point A, if this is a high, you would assume this area here should be your point A. While point B shows where the market pulls back a little from the point A. That's what point B shows. Finally, the point C refers to the final move before a potential reversal or continuation. So that's the pattern here. This is the ABC pattern. What makes this pattern particularly powerful is the ability to show you where the smart money is positioning itself. When you see an ABC pattern forming, you are essentially watching the institutional traders and the large market players leaving their footprint in the market. So let's get this on the chart. Okay, yes, this is in case of a bearish ABC pattern. This is the A point, this is the B point, this is the pullback. Remember, the B point is the pullback, then this is the C point. Remember, the ABC pattern is not just about connecting three random points on your chart. Each point serves as a specific purpose in telling you the market story. Point A shows you where a significant move began, while the point B reveals how much the market is willing to pull back, and the point C gives you the crucial entry opportunity. The key to mastering this pattern is understanding that it's not every ABC formation will lead to a profitable trade. However, when combining with proper risk management and market context, it becomes a powerful tool in your trading toolkit. Now let's see how we can trade this ABC pattern. Now understand that the ABC pattern is actually a strategy that is about finding the right entry points, managing your risk and maximizing your profit potential. This is how we actually apply it with confidence. Step 1, we identify the point A. Let's look at this bullish illustration. Identifying the point A, which is the initial move in the market. This is the initial move in the market. This could be a strong upward move or a downward move. The movement that stands out on your chart. You are looking for a clear trend direction. Let's not forget, it has to be a clear trend direction. And it's either a strong rally in a bullish market or a sharp drop in a bearish market. So in case of our bullish illustration. It is a sharp move upward. Now B, we have to locate point B, which is where the market retraces after an initial move. The market retraces down here. So this is our point B. This is a pullback which gives you an indication that the market may be preparing for another leg, either in a continuation of the trend or as a part of a reversal. Let's not forget that the retracement shouldn't be that deep. However, after the strong upward move from the point A, price pull back to form the point B. This is a retracement signal that the buyers are taking a break. This is not yet clear whether the trend will continue or reverse. While the point C is where you will start paying attention, because this is where your entry opportunity lies. After the point B, let's not forget, price will pull back significantly again to form the point C. The final pullback is often shallow compared to the previous ones, and the signal that the market may be ready to resume its original trend or reversal. In this case, after reaching the point B, price pulled back again, but not so deep, to form the point C. This is where we will prepare to take our trade. So if we are preparing to take our trade from this area, let's use our long tool. This is where the market pulled back again. We'll take our trade here. Don't forget, the signal to enter this trade is when price pulls away from the point C. That's if it is in a bullish ABC pattern. We are looking for buying opportunities. Price has to rise from this point C. And if it's in a selling situation, a bearish market would look for price falling out from the point C. Let's not forget our risk management. We are always going to set our stop loss below the previous level, below your point B level. I think I would have to label this. This is your point B. This is our point A. And this is our point C. Now, to ensure if the market moves against you unexpectedly, that your losses may be limited, that's why we put our stop loss below the point B. Now, finally, we'll talk about taking profits. One common approach I use to take profit is using the Fibonacci extension, typically targeting levels such as the 127 level or 127 level or the 161 level. Or basically, you can just use a fixed risk to reward ratio, like 2:1 or 1:3. Like I always prefer using 2:1. Using the 1:2 risk to reward ratio also gives us room to allow price movement. Now let's look for another example. We can use this in case of a bearish ABC pattern. We'll use this. This is our significant movement This is our little retracement. Then this is the movement showing that price is ready to go in that direction. Then there will be a little bit pullback. This is where you would enter your trade at this particular area. Now, in case of going bearish, we can take it somewhere around here, putting our stop loss slightly above the lower high. Then we target a 1:2 risk to reward ratio. Now, by following these steps, identifying points A, B, and C, you can trade with more confidence and precision. Always remember to wait for the confirmation before entering trades, and use proper risk management with stop losses and profit targets in place. Alright traders, we have come to the end of this video. Engage with us in the comment section below. We want to hear about your experiences. If you found this video useful, helpful, do not forget to like, subscribe, share, and turn on your notification bell so that you don't miss out on more uploads on trading tips and strategy. Thank you for watching, and we will see you in the next video. Thank you.